In this week's update, global fundamentals improving, traditional thinking is holding investors back, and the party rolls on elsewhere. My name's Gary Davis, and as always, this is general advice only. And remember to subscribe and like the video. All right, just a quick bit of overall perspective. The fundamentals globally are improving, and they're improving at a surprising rate. And I don't think anyone really expected this, but it just goes to show that the market rise over the last few months out of that crash in February, March, is really just pointing to what the smart money, had a pretty good idea was coming with all the stimulus. So we're seeing pretty much universal strength in global PMIs, or Purchasing Managers Index. And for those that aren't familiar with that particular index, it's basically the outlook for purchasing managers, and it's a good barometer of economic activity. And they're actually improving not only at a surprising rate, but almost universally as well. And that's really underpinning what's going on in the market. So yet again, the habitual bears, the people that always want to take a negative slant on life, are getting stitched up again because they're either short the market, or they're not participating in the rebound, or they sold out at the lows, or whatever it was that they did, but they're being stitched up again. And the herd is still, to a fair degree, pretty oblivious to the macro trends that are going on. Now, people that have been watching this video for a lengthy period of time know that my fundamental orientation is bullish, and we're certainly in a secular bull market, so why not? And yet most people come to that party very, very late. So this is a long-term secular bull market. Yes, there will be some more events like we saw in February and March, for sure. That's the sort of thing. 1987, which was the sharpest crash of all time, sharpest single day crash of all time, occurred during a secular bull market. So just because you're in that type of long-term environment doesn't mean you're immune from significant crashes. But what it does is that it means the mini panics create opportunity, and that's the key takeaway here. And there's just been some amazing opportunities in the last 3 months. Let's look at American stocks. The S&P rose 4% on the week. There was some late selling on Thursday night, but it just in the final hour or so, but it turned out to be a pretty solid week, and it's not that far off its all-time highs. The main driver was a great jobs report, again just showing surprising strength and confounding most people. Plus, we're seeing earnings guidance. We're seeing earnings being reached and exceeded, and we're seeing guidance being raised above expectations. And those companies and sectors are the ones that are doing exceptionally well. Looking out to the end of the year, my largest potential disruptor continues to be the election result. And this is not a political comment in any way, but if the Democrats win, then there will be significant change to tax, government red tape, and quite a number of things which are going to be negative for the market. So, that will not be a good outcome for the market. The US dollar slightly lower at 97.32. And the 10-year yield also slipped just a tiny bit as well to 0.68%. Okay, let's just take a quick look. So this is the monthly chart of the S&P. So right over here on the left-hand side, we're looking at 1997. So that gives you about 23 years of pricing history. This was a secular bear market which occurred between 2000 and 2013 when it emerged, and we are now in a secular bull market that has been running for 7 years. Often secular bull markets will run for anything up to 20 years, and I don't see any reason why this one can't be any different. But just remember that you still do get cyclical bear markets occur during that period. But certainly significant sell-offs are an opportunity. Let's just come in a little bit and look at the action on a daily basis. So we had a breakout above an important high, which occurred in June, early June, and then since then we've been consolidating almost exactly around just above and below that particular support and resistance level. And really, the most likely outcome in the short term is that the market will continue to do this at the index level. But having said that, there are some sectors that are just doing so much better. It's incredible. And if we look at the Nasdaq, as now this is an overall index that is comprised of many different sectors, but you can see just how much better the Nasdaq is doing. And then if we go down to a sector level, you'll see that that's amplified even more. US dollar, pretty steady and stable over the last couple of weeks, and the Australian dollar is also back into a consolidation zone. So we were in a sideways zone between 67.5 and 70.5, so about a 3-cent range. We dropped out of that during the crash, but it's just come back into it again now and just seems to have comfortably settled down in that range. So that's the most likely area that the Australian dollar will trade, somewhere between 67 and 70. Now, let's just, while I'm here, let's just look at the Australian index. So this is the ASX 200. So there is a bias to the upside, but it's pretty slow and laborious, and it's underperforming the American market quite considerably. If we look at the Australian market on a bit of a sector basis, so what I've done here is I've put the financial index, so the banks, which is the blue line down the bottom. Above that is the industrials, and then above that we've got the small ordinaries index, so that's indicating that the small end of the market is outperforming the industrials and the finance sector by quite a way. And then slightly above that we've also got materials, so that's obviously BHP and Rio and Woodside and Fortescue Metals and stocks of that nature. But the key takeaway here is that small caps are doing well and commodities are doing really well, which is really no surprise when you understand the cycles and the fact that we're now entering a period which should be pretty good for commodity prices. And I'll just show that one other way, and these aren't recommendations. This is just an observation of where the opportunities are in the Australian market. So I will use the finance index, so the XFJ, and I'll compare it with some of the really good businesses. These are not just stocks that are going up. These are seriously good businesses that that people can can consider getting into. So NXT, APX, XRO, and let's just throw in a small gold stock as well. And that gives you a pretty clear picture of the opportunities and the lack of opportunities for people that want to do things in a traditional way that is occurring in the Australian market. So we've got finance index right down at the bottom. So this is on a 12-month view, all starting at the same point, and it's just showing you the relative performance. And you can see that relative performance is really opening up of late since the crash. So finance index at the bottom, then we've got APX, then we've got XRO, and then NXT, which is in the data center business. And then we've got a small cap emerging gold stock, which is still a really promising looking business. Now again, these are not recommendations. This is merely to make the point that there are unbelievably good opportunities in the Australian market if you can get yourself away from traditional thinking. You know, what the brokers would tell you that you should, how you should put your portfolio together, what a lot of financial planners would tell you how a portfolio should look. In actual fact, the real performance is done in a different fashion. So just to recap on that, the Australian dollar was higher slightly to 69.1, and our index was up 160 points on the week. And as I've shown there, it's small and mid-cap growth stocks in sectors that have got tailwinds. So those stocks that I showed were predominantly technology stocks, plus obviously a gold stock as well. Commodities do look appealing for the next 5 years. So at the big end of town, you've got the BHPs and the Rios, obviously, but there's many, many other opportunities. And we're seeing terrific support in the market for Australian uh, exploration companies in the resources sector. So the question that I want to put in everyone's mind is, why would you want to severely limit your return and raise your risk by chasing yield and going with traditional thinking? I really urge people to start thinking about total return and not yield return, because in seeking yield, you can be taking yourself into stocks that are actually downright dangerous, and you can end up losing a lot more on the capital value side than you actually gain in dividend yield. So it's a really important point to ponder. It goes contrary to traditional thinking, and there's just been some wonderful performance in those particular stocks. Turning now to precious metals, gold rose $5, so we're still working our way up to this 1800 level, and a breakout above 1800 is going to bring in, I believe, significant additional selling. It'll almost certainly bring in the futures speculators that currently are not in the market, because the level of long contracts are just almost at historical lows. So the futures speculators aren't there yet. This corresponds to an Australian dollar gold price of 25.70, which makes the Australian producers with all-in sustaining costs around about the 1100 to 1300 mark, makes them outrageously profitable. GDX was higher again, so very good week there. And I put this in last week, so I just want to reiterate again. They're still underperforming the metal. So that if we looked at the GDX to GLD ratio, stocks are still lagging. And stocks are also very cheap on an earnings per share basis versus their traditional valuations. So whichever way you carve it, things look very, very good for this particular sector. Let's just jump in and take a look at gold and silver. So there is gold on a daily basis. So just working its way higher and sustaining this really nice uptrend. There's the channel on a weekly basis, and we're closing in on this important 1800 level. So let me just extend that across there. So you can see we got very, very close to it during the week. In fact, hit a high of 1790. So we might get a little bit of consolidation. You can see we're in the top half of the channel here. It's quite possible we could pull back into the lower part of the channel in some sort of consolidation before we actually get a breakout. So that could possibly see gold pulling back as much as $50 or $60. But if that happens and it remains within the channel, then don't worry about it, because consolidation underneath a key resistance level is really what you have to expect. It's a bit unrealistic to expect that the gold price is just going to motor straight through this long-term resistance level. That peak was set back in 2012, and gold went into a bear market for about 4 years after that. So expect some consolidation, but when it breaks, and I think that looks highly probable, then there will be a surge of new players coming into the market. The other point that I'd also make about gold is that there is a seasonality aspect to it. June, July has always been a weaker period of the year. That seems to be getting compressed into June. So it may well be that we're now more quickly getting into a period of outperformance, and that tends to happen in August, September. Is traditionally a better seasonal period for strength in gold. So some key things to watch there. Let's look at GDX. This is on a weekly basis, so we had a really nice breakout in April. We got a three-week retest coming back into June, so that's the weakness period showing through, and now GDX is taking off again, probably in anticipation of that seasonal strength in the gold price. Turning to other commodities, copper was steady at $2.71, and crude oil was up about 4 or 5% to be back above $40. And there's the spot copper chart. So wrapping it up, the market always looks forward. And the thing that seems to trick most investors is that they want to look at what is happening today and what the market is doing, and they see this disconnect. The market always seems to be doing something different from what the current circumstances are. And you've got to understand that the market is always looking forward, and the market is always allowing for human ingenuity. The fact that we can get ourselves out of seemingly very difficult situations a lot more quickly than what anyone expects. Companies are raising forward guidance. They're the ones that are being rewarded very, very handsomely. And a lot of people are standing back and pointing at some of the trends and saying, they're ridiculous, they're stupid, but, it is what it is. And history will show that those companies were doing far better than what people appreciated. So we're in a situation where the winners will continue to power ahead and the losers are going to continue to struggle. If you stay with traditional thinking, a lot of what you own are going to be losers and they're going to continue to struggle for a lengthy period of time. So I'd strongly urge you not to stay in that camp. Why own stocks with headwinds just because traditional thinking says that that's what you should own? It's really misleading. Portfolio analysts this week, just more high probability setups. They're absolutely everywhere. I've got hundreds of them in the US, not quite hundreds in Australia, but a lot in Australia. They're just absolutely everywhere, and it's a very, very exciting time at the moment. That's it for this week. There's my email address for anyone that wants to contact me, and the website for any additional information on the services that I offer. So I'll be back with you next Sunday. Cheers.